Is the global economy heading toward its next big crash? Some experts believe a massive economic bubble is quietly forming right now. From rising debt and inflated asset prices to overvalued markets, warning signs are starting to appear across the financial world. History has shown us what happens when bubbles burst, from the dot-com crash to the 2008 financial crisis. The real question is, are we repeating the same mistakes again? In this video, we'll explore the economic bubble that experts are warning about, what's causing it, and what it could mean for the future of the global economy. Today, we will talk about the economic bubble that experts are warning about. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding economic bubbles. An economic bubble occurs when the price of assets, such as stocks, real estate, cryptocurrencies, or technology companies, rises far above their real or intrinsic value due to speculation, excessive optimism, or easy access to credit. Bubbles are not a new phenomenon. They have appeared repeatedly throughout economic history. Famous examples include the tulip mania of the 1630s, the dot-com bubble of the late 1990s, and the global housing bubble that triggered the 2008 financial crisis. These events follow a similar pattern: rapid price growth, investor enthusiasm, speculation, and eventually a sudden collapse. Economists warn that bubbles can damage entire financial systems because inflated asset prices encourage excessive borrowing and risky investments. When the bubble bursts, asset values crash, debt becomes unmanageable, and banks or financial institutions may fail. Research on financial crises suggests that asset mispricing and speculation are often major contributors to economic downturns and recessions. 2. The rise of the everything bubble. Many economists today believe the world may be experiencing what some call the everything bubble. This term refers to a situation where multiple asset classes, stocks, real estate, cryptocurrencies, technology companies, and even government bonds are simultaneously overvalued. According to economic analysts, years of extremely low interest rates and aggressive monetary policies after the 2008 financial crisis flooded markets with cheap money. When borrowing costs are low, investors tend to take greater risks, pushing asset prices higher and higher. Dr. Mark Thornton and other economists argue that this environment has distorted the allocation of capital across global markets. They warn that real estate, financial assets, private equity, and government debt have all become vulnerable because they rely heavily on borrowed money and optimistic growth expectations. This interconnected system means that if one major sector collapses, it could trigger widespread instability across the global economy. 3. The potential AI and technology investment bubble. One of the most widely discussed risks today is a potential artificial intelligence, AI, investment bubble. Over the past few years, massive investments have flowed into AI startups, data centers, and advanced computing infrastructure. Technology companies have spent billions of dollars expanding their AI capabilities in anticipation of a technological revolution. However, some economists warn that investor expectations may be far ahead of reality. Reports indicate that many companies investing heavily in AI have not yet generated significant profits from these technologies. In fact, one study suggested that about 95% of companies investing in generative AI have not yet seen financial returns from those investments. If AI projects fail to deliver the expected revenue growth, investors may suddenly withdraw funding, leading to sharp declines in technology stocks and investment markets. Such a scenario could trigger a global financial shock similar to, or even worse than, the 2008 crisis. 4. Growing debt and financial market vulnerabilities. Another major concern for economists is the rapid increase in global debt levels. Governments, corporations, and households have accumulated unprecedented amounts of debt over the past 2 decades. Rising interest rates and inflation can make this debt increasingly difficult to manage. According to recent financial warnings, Global borrowing is expected to reach tens of trillions of dollars annually, placing enormous pressure on bond markets and financial institutions. If investors lose confidence or interest rates rise sharply, heavily indebted countries and companies may struggle to refinance their obligations. Such stress in the debt markets could trigger financial contagion, where problems in one sector spread to others, potentially causing a major economic downturn. Experts say this combination of high leverage, rising interest rates, and fragile financial markets is one of the biggest risks facing the global economy today. 5. The role of speculation and investor psychology. Economic bubbles are not driven solely by financial policies or market conditions. They are also fueled by human psychology. During periods of economic growth and technological innovation, investors often become overly optimistic about future profits. This optimism encourages speculation, where people buy assets not because they are valuable today, but because they believe someone else will pay a higher price tomorrow. Social media, online trading platforms, and widespread financial news can amplify this behavior by creating a sense of urgency and fear of missing out. Retail investors sometimes enter markets late in the bubble cycle, purchasing assets at inflated prices. As enthusiasm spreads, asset prices become disconnected from real economic fundamentals. When reality fails to meet expectations, such as slower economic growth or declining corporate profits, panic selling can occur, causing markets to collapse rapidly. This cycle of optimism followed by panic has been observed in nearly every major economic bubble in history. 6. Private credit and shadow banking risks. In addition to technology and debt concerns, experts are increasingly worried about the expansion of private credit markets, which operate outside traditional banking systems. Private credit involves loans provided by investment funds and non-bank financial institutions rather than conventional banks. While this system provides alternative financing for businesses, it is often less regulated and less transparent than traditional banking. Financial leaders have warned that the rapid growth of private credit markets could create risks similar to those that existed before the 2008 financial crisis. Hidden leverage, limited oversight, and illiquid investments may increase the likelihood of financial instability if borrowers begin defaulting on their loans. 7. Warning signs experts are watching. Economists and financial analysts are closely monitoring several indicators that often appear before economic bubbles burst. One major signal is extremely high asset valuations compared to historical averages. When stock market prices rise far faster than corporate earnings, it may suggest that investors are pricing in unrealistic growth expectations. Another warning sign is excessive borrowing used to finance investments, especially when those investments depend on optimistic future profits. Rapid growth in new financial products, speculative trading, and sudden surges in technology investments can also indicate bubble conditions. 8. What could happen if the bubble bursts? If the economic bubble currently forming in global markets were to burst, the consequences could be severe. Asset prices could drop dramatically, wiping out trillions of dollars in market value. Banks and investment funds exposed to risky assets might face significant losses, potentially triggering financial crises. Businesses dependent on investment funding could collapse, leading to layoffs and rising unemployment. Governments may also struggle with increased debt burdens and slower economic growth. However, not all economists believe a catastrophic crash is inevitable. Some argue that markets may experience a gradual correction rather than a sudden collapse, allowing the economy to adjust over time. If you liked this video and would like to see more like it, please give it the thumbs up.